Hi, everyone. Welcome to our International Week here at XP. I'm Fernando Ferreira. I'm the Chief Strategist and also Head of Research here at XP. We have translation for this panel, so you can watch us both in English and also in Portuguese. So during this week, we prepared a great agenda for all of you. We'll touch on the most important topics, right, regarding international investments and why we should diversify our portfolios internationally. And also we touch on the most important topics, right, when we talk about international diversification, including ETFs, the BDRs, including crypto assets, funds, including macro views in China, the world. So we're going to cover a whole set of different topics during this week. We have 10 panels prepared for you. This is the first panel of our week, and we have no one better than the largest asset manager in the world, right, BlackRock, to start this International Week here with us. I have the pleasure to welcome Mark Wiedman. He's the head of international at BlackRock, and we'll cover a lot of topics here in our conversation. Mark, welcome, and thanks for joining us.
Oh, Fernando, thank you for having me. And I want to say thank you to XP, which I think is one of the most innovative and interesting firms that we work with in the world. And I also want to thank everyone in Brazil who's joined us for International Week. I think these are transformational times for global investing for Brazilians. And it's my privilege and honor to be with you today.
Great. Mark, maybe we can start with a very broad discussion, a very ample sort of discussion. I mean, we've gone through very different times, right, to say the least, very volatile times over the last 12 to 18 months. But during and post the pandemic, we're still going through the pandemic here in Brazil, but the world is already looking right beyond what happens next. And I mean, we've gone through different phases, right? Different stages of the investor psychology and the market cycles as well in a very short period of time, right? So I guess we could start there, maybe discussing what have we learned as an investor, right? What can we take from all of this that has happened, right, in the last 12 to 18 months, and what are the learnings that we'll carry on going forward?
Well, Fernando, I first want to say, as I think we're all in this together as human beings, and New York has had a really rough run for a long time. Brazil is having a rough run now, and I just want to say, as human beings, that we are all in this together, and this pandemic won't be over until we have properly vaccinated the whole world. So what did we learn as investors? So this last 15, 16 months has been like a roller coaster ride. We started off in March of last year, late February, with the beginnings of what looked like a market crash at a speed that we had never seen before. If you go back to the financial crisis, but actually I'll call it the Western financial crisis of 2008 and 9, it took 18 months for prices to actually get down to a real bottom. And what we saw in March is that financial markets globally, but especially in North America and Europe, went as far down in about 3 weeks. So the system was in, I would say, shock. The first thing we saw in response was unprecedented and effective levels of fiscal and monetary policy intervention from the US and Europe. In the US, obviously, extremely aggressive moves by the Congress, but also by the Federal Reserve to immediately bring rates down and inject huge amounts of funding into the economy, which kept the U.S. economy from slipping into a recession and slipped into a recession, potentially a depression. I will say in March and April of last year, most CEOs I spoke to were getting ready for giant loan losses in bank portfolios, for example. And we were debating, do we need to actually make a big reduction in force and exit tens of thousands, lots of people because we decided we were not going to do that, but it was the kind of question in the air. And then suddenly that U.S. intervention, and then in Europe, intervention by the ECB, but aggressively by the European Union in the early summer to actually have a fiscal response for the first time at the European level, actually turned the course. And so I think the first lesson of this is, as investors, we are ultimately, we can do a lot of analysis and think a lot, but ultimately it's the decisions of the state which drives a lot of the outcomes we experience. Second is so many things accelerated during this pandemic. We saw the trends that had already been going on accelerate, like sustainable investing, which I'm sure we'll talk about later. But we also saw some new things. So low rates, or even negative real rates, meaning taking the nominal inflation rate and then, taking the nominal interest rate and subtracting out the inflation rate to get the real rate. Low rates had been a yen problem in Japan, then it was an Eurozone problem in Europe, and now it's a global problem. So in sterling and in dollars, if you buy US Treasuries, for example, or you buy gilts in London, 10 years, you are basically handing value back to the government every year. Right now, it's about negative 50 to negative 75 basis points per year on US Treasuries. That's a new phenomenon, sustained, and no one really sees how that's going to change. Inflation is rising, but interest rates are not. In Brazil, we have negative real rates for overnight funding. That's new. That's a shock change to Brazil. So that's an acceleration of a trend that was already spreading from the rest of the world with basically an ocean of liquidity. We've seen a huge growth of interest in private markets, specifically in private credit, private equity, and infrastructure, because everyone is desperate to find ways of getting a little extra return in this low-yielding world. And then I would say clients all over the world are reconsidering their basic portfolio allocations from foundations. Why? Because about March, April of last year, first, their portfolios started behaving in very strange ways they hadn't expected. A lot of things correlated, all going down at the same time. But the second part is that with rates going down to real zero or negative rates across the big developed markets, clients globally are wondering, why do I own sovereign debt at all in these portfolios? A lot of the logic for owning that sovereign debt has disappeared. At least for insurance companies and pension plans have to buy matching assets to their liabilities. But for most of the people joining us today, Fernando, you don't. And so the question is, if you're a total return investor, why do you own sovereign debt? At least as a structural position in your portfolio as opposed to a tactical position. These are all big changes that weren't true 15, 16 months ago. And then the last thing I'd add, the digital transformation. All of us, everywhere, are doing so much more digitally than we did 16, 18 months ago. And we know this in the rise of shopping, online shopping in Brazil. We see that in the United States. We see it in Western Europe. We see it in Japan, in China. Everybody, things that were being done through going to a store even 2 years ago, now people are like, why would I go to the store? That seems silly. And interestingly, in financial services, countries that never had any real digital investing are now seeing an explosion. And Brazil was actually ahead of the curve on this relative to many other countries. But today in Germany, for example, millions of new accounts are being opened in a country that really had almost no digital investing even 2 years ago. So I think that's also accelerated in our world.
We probably won't go back, right, to our old habits, right, pre-pandemic.
I think it's, Fernando, it's a shock actually for all of us, because we all have a desire to think it'll be just like before. But of course, it's not going to be like before. Big companies, for those of you who work in big companies, the management are all trying to figure out, are we going to get people back to the offices or not? And we're all having to learn.
Will they come back to the office, right? That's another question as well, right?
Exactly.
Yeah. But Mark, you touched on a very important point, and one that people have been discussing a lot recently, which is the risk of inflation, right? The risk that all of this stimulus that was put through, right, on a synchronized basis globally, and that it still continues, right, still going on in 2021, despite the fact that we're probably going to see the world growing around 6% in this year, and another, I don't know, 5% next year, according to some projections, right? But I guess the risk of inflation is one that people have been discussing a lot, not only in Brazil, also in the US, even in Europe, right? There is this huge fear against inflation. So my question there would be, what's your view, right, on this topic and the risk that inflation is not transitory? Is it transitory? But also, and maybe more importantly, how can investors protect their portfolios, right, against the risk of inflation that is stubbornly high?
So, Fernando, thanks for laying out this question on inflation. I can give a view on the path for inflation, and I can give a very confident perspective on what to do about it. So, on the view, I mean, no one knows the future, but I think we're going through an unprecedented experiment in huge fiscal and monetary expansion in dollars. And then in the Eurozone, we're also seeing pretty big fiscal expansion, but not on the same scale. I think I would say our base path for inflation over the next 3 to 5 years has increased, let's say, 50 basis points, 75 basis points from what it was a year ago. But we see this recent surge, as transitory, as actually representing short-term supply bottlenecks in the US economy. Right now in the United States, demand is intense. We see people have been trapped at home for a year. They didn't lose their jobs, so they kept earning dollars that are sitting in bank accounts, record levels of cash being held by people. They haven't been on holiday anywhere in over a year. And now the country's opening up and everybody wants to spend. And so if you want to, like, the price of lumber, of wood, has doubled because everybody who's been staying at home has decided the 7 things they want to do to their house. So they're all putting things on their house. Everything is getting more expensive because of the short-term surge. That's a short-term constraint. Semiconductors, obviously, there's going to be inflation in semiconductors. And put on top of that, the fact that the US is re-engineering its supply chains to be less dependent on China. All of that, plus a shift toward clean energy away from hydrocarbon-based energy, all of that is putting short-term price pressure and probably lifting overall long-term inflation expectations a bit. But we don't see a runaway path, but we do see a lifting, and that's in the US. I would say everything I've said is true in the Eurozone, but quieter. However, what do you do about it? Okay, so we don't know. Maybe I'm wrong. Maybe it goes up even higher. If you read Larry Summers, the former US Treasury Secretary, he's been quite vocal that he thinks his colleagues in the White House have gone out of control. I don't know. Sovereign debt is one way, if that's at all true, of losing money. Okay, so what I would say is we all, and this includes in Brazil, all reconsider the role of sovereign debt in your portfolios, because if you do believe there's a risk of inflation going, well, if you believe that the central path is inflation's a little higher, just calculate the real yield you're earning. Right now, treasuries, US treasuries, about 1.5, 1.6% yield. Inflation rate is 3% this year in the United States. Well, you just handed 150 basis points of value to the United States government. So I think you have to do that basic math and ask, are there other assets that are not fixed income, that are, or at least not so negative real yielding? So whether it's credit, but also in equities, and of course, international.
How about commodities as well, Mark? Commodities, REITs, other types of alternative investments as well to
sure. I mean, again, I think that if you believe that we're moving into a more inflationary period with a surge of demand coming, then I think that commodities actually, I think, are a good bet. I agree with that position. So I think that's another asset. Again, the problem is so many of our clients globally are heavily in sovereign debt as their backbone of their portfolios. And those portfolios are just, they have very little upside. And unless you believe that rates are going to go up dramatically in the near term, which I don't really see, I think it's not. We don't see that as being a structurally positive place really anywhere, with one exception actually, which is Chinese sovereign bonds, which are the only place in the world, a big market, you can get positive real yields, even at the short end of the curve. And so we think Chinese bonds are worth taking a look at.
Interesting. Yeah, in Brazil we have exactly the same problem, and overnight rates, the 1 year rates is at 3.5% at the moment, and inflation is running past 7% already, the accumulated 12-month inflation rate. So yeah, it's a big problem, especially for an investor base in Brazil, which has grown used to very high yields on fixed income, right, and double-digit fixed income yields, and haven't really lived through a period of negative real rates as we are discussing right now, right? So the shift in portfolios, I think, is really a new paradox, new paradigm here in Brazil, and to that extent, I'd like to ask a question as well on the roles of active versus passive investing, right? Because nowadays we have so many options for investors when we talk about, for example, international diversification, right? And you have BlackRock's funds, right, with an active manager there trying to beat the index, but we also have the BDRs, we also have the ETFs. And I see investors several times are a little bit lost, right? And what sort of options do they choose to their portfolio? So maybe if we can touch on this subject, on active versus passive first, and then we can go through and talk about ETFs and more specifics.
Sure. Well, I think the first thing I'd say, Fernando, is you've laid it out very cleanly, is that this shock of basically for a very long time, Brazilians didn't need to go abroad because you could earn positive, serious, real yields with very little risk just by going overnight. That's a state of mind that Brazil has been in for a long time. I've had the privilege and the pleasure of working in Brazil for a long time. I've been coming, hoping for more interest in international exposure. But the truth is, if you can make 400 basis points, 4% real yield, pretty good returns. Might as well just do that. That's changed. And that's a shock to the portfolio that then says, okay, what do I do? And so this question of active versus passive, Fernando, if I can just say something almost above that in terms of logical importance. The most important question is not active versus passive. The most important question is your broad asset allocation. Which markets are you in? So there's not a lot of detailed analysis, interestingly, not too many studies that can carefully calculate how important is the relative contributions of different parts of your portfolio, your asset allocation, tactical, strategic asset allocation, individual products, security selection, etc. But the best analysis that we've seen comes from the Norwegian Sovereign Wealth Fund, Norges Bank. What they did is looked at their portfolio and said, what portion of our returns are coming from broad asset allocation, including tactical moves they've made? So in other words, they overweight European equities or underweight them relative to their benchmark, versus individual products and picking individual stocks and bonds globally. And their answer is, I often ask people, what do you think that percentage would be? And they'll say, I don't know, 80% for asset allocation, 90%. Their answer in multiple studies over different time frames is between 99.3% and 99.7% of their returns come from broad asset allocation. So that's the Norwegian Sovereign Wealth Fund, best analysis we've seen. I think what that means is this question of active versus passive is really a secondary question. The important question is, what is your broad allocation? And I would say broadly, we think Brazilian investors are massively underallocated to the rest of the world. And they're underallocated, again, historically, there was no reason to actually look outside. Maybe it was still a good idea to be diversified, but habit is hard to break. But now the habit has to be broken because what used to work no longer works. To give you some numbers, if you look at retail or institutional portfolios in Brazil, about 2% of those portfolios are invested abroad. That's true, and pensions is going to be even lower. And so let's just say, what happens in other countries? What are other countries doing? Well, the rest of Latin America is at 10%. So Brazil's at 2, Latin America's at 10, but the rest of Latin America also has lots of home bias. Okay, most people across Latin America invest in domestic fixed income. That's their main investment. So what about going further? The number in China is about 8. Interestingly, China, like Brazil, is a huge continental economy that has a largely closed investments universe. The number in the United States, which is a fairly large economy itself, is 25%. So in other words, 25% of institutional portfolios are overseas. And in Japan, the number is 42%. So Brazil is a real outlier, very low allocations. Our view is that Brazilian investors should go to about 30% of their portfolios being international. This is our math. We could argue about it, but 2 is definitely way too low. And the reason is you get the magic of diversification benefits when you get well over 10%. This is the only free lunch in economics. Okay, for those of you who took economics in university, it's the only thing you get for free, which is if you diversify your portfolio with uncorrelated risks, you will actually do better on average. And so we would urge clients in Brazil to go abroad, unhedged. Okay, I know this is hard. Brazilian clients love to, it's like with Brazilian currency risk, I'm sure we'll talk about that. It's either the real is too cheap, and why would I possibly go abroad? Or it's rich, but local rates are good, so why would I ever go abroad? I think the answer is go abroad. Then your question, Fernando, about active versus passive. That's a question of implementation. It's an important question. I'll talk about that. But really, foundationally, what is your broad allocation? And go whichever way you want. Now, I'm going to, if I can politely reject the question, active versus passive, I think, is a framing we need to throw away. We just got to toss that framing right out the window. And the reason is all portfolios are active. When you build a portfolio, your asset allocation, however you build it, whatever bets you make, that is the active decision. When we talk about active versus passive, we're talking about this instrument versus that instrument. And we're specifically talking about, is the product attempting to beat an index or copy an index? If you can find a product that can actually outperform, you believe can outperform the index, you should totally buy that product. We actually sell, that's a huge part of BlackRock is selling active funds. But if you don't have confidence in a specific asset manager, you should buy an index exposure, an ETF, because that gets you in the market and you've made the primary decision. And if later you find somebody you love, buy her product. But until then, the ETF is a good default position. So it's not active versus passive. It's the whole portfolio is active. Active mutual funds, which is what we're really talking about, are specific ways of getting exposure with the hope of a little extra return, maybe. The ETF is going to be a low-cost, efficient way of getting there quickly, but that doesn't try to outperform. And that's really the choice. But it's a micro decision versus the macro decision of what your portfolio looks like.
No, that was excellent, Mark. I didn't know those numbers, but they're shocking, right? To understand that we only have a 2% allocation of
Fernando, it's not. I mean, look. Here's the thing. Brazil is the way I think about Brazil is it's not a country. It's a civilization. Okay. When you go there, you feel it. It's like you've walked into an alternate universe. You've got great tech firms and a giant country, but it's actually a small country in the global landscape. And so I think that, look, Americans can be parochial and inward-looking too, very much so. I would just encourage our clients here to consider investing abroad because it's a very big world and you can get free diversification, free because you quickly pay for itself simply by diversifying and holding your portfolio. So anyway, sorry, Fernando.
No worries. But I was going to say, I mean, but the regulations as well, right, were very strict up until, let's say, 18 months ago. So it's also new, right, the amount of products and options, right, that the Brazilians have to invest abroad. So I'm sure that number is going to grow, right, quite fast. And I also agree with you regarding effects, right, because all the meetings I do with with our IFAs and our clients, I always tell them, look, invest in dollars, right? Don't invest internationally on a hedged basis. It doesn't make any sense to buy Apple or Amazon, right, in reais. That's not their functional currency, right? They make money in dollars, so you should invest in them in dollars, right? And people are always afraid of this FX volatility, right, when they invest abroad. What do you have to say about this subject, about FX volatility? Should people buy an international ETF and be thinking about the real? Is that the right way to look at it, or should we just not think about that and think about that as the dollar portion, or let's say the foreign currency portion of our portfolio?
So because Brazilians generally are starting at such low allocations, okay, to international investing and to FX risk, my view is go abroad, go unhedged. You can get every extra, and don't wait for the optimal allocation. The answer is more than you're doing today. Okay, so it is partly for this reason. If you had if you're a Dutch pension plan, okay, which allocate heavily overseas, basically 90% of a Dutch pension plan will be outside of Holland, or a British pension plan, which will be majority of equities will be outside of the UK. They have to worry a lot about hedging currency risk or not, because it has a huge impact on their portfolio. They've basically taken a bunch of liabilities in euros or sterling, and they're now invested abroad, and they actually have a matching problem. There may be an exception out there in XP land somewhere, but I would suggest that not a single one of our clients here, Fernando, has that problem. Everybody's starting way over at the other extreme, where you have almost no international exposure or very little, and adding international exposure unhedged will increase diversification in your portfolio. The other thing I would say is Brazilians spend a lot of time talking about the real and thinking about whether it's cheap or not. Look, when I started having these conversations about investing internationally, the real was at about 2 to the dollar. And everybody told me, no, because it's great to invest in Brazil. We don't know. I'm not saying that I don't know the future, but I do know that if you hold more pots on your desk, it is more likely that you will over time perform than if you put everything in one pot.
Exactly. And especially considering that Brazil is only 2% of global GDP and less than 1% or about 1% of the global market cap, right? So I always say, look, if you're only investing in Brazil, you're missing the other 98 to 99% of the world, right? So it doesn't make any sense, right, to have such a focused allocation only in Brazil, right? Because you can have a very diversified portfolio of different Brazilian assets, but at the end of the day, if there's an issue in Brasilia, right, and any political risk, your whole portfolio is going to be exposed to that same risk at the same time, right? And so the next question, just going one level, right, into more detail, and we can talk about ETFs, right? Because I think that's the one area we're seeing a lot of interest, and also a lot of new products, very interesting products, right, being launched on the ETF space. That was an area where people didn't know much about up until a couple of months ago in Brazil, and it's an asset class that has well over 10 or 15 trillion dollars, if I'm not mistaken, globally, right? And it's been growing double digits for decades now. So what roles do you see ETFs playing in a portfolio? And for an individual investor, why are ETFs a better option, let's say, than buying a single stock, in your view? I mean, can you touch a bit about the subject? And also, BlackRock has been launching, right, several ETFs in Brazil through BDRs. So now there's a whole bunch of international exposure, right, through ETFs that we can do here in Brazil, right, through ETFs. So if we can touch about this topic.
So a couple of thoughts. First of all, I'm so excited about the change we're seeing in Brazil. Today, we've been working on this for 10 years. So I've been coming to Brazil, waiting for the market to change for 10 years. And it's finally changing, which is domestically, clients, you are out there buying ETFs in the form of BDRs to access global markets for the first time. There have been lively or sizable ETFs on Brazilian markets, in particular the Bovespa, that we've had in Brazil for a very long time, largely used by some pockets of wealth, but mostly institutions. And institutions in Brazil have been using foreign ETFs where they go to London or New York and buy there for a very long time. But the change now is that XP is democratizing, bringing these global exposures to you through these BDRs. And so we can work with you. Well, we're doing that too. We're launching, and we are launching many more to come. And all that a BDR is it's just a local copy, effectively, of a ETF listed in the United States, and eventually we'll be taking ones in Europe to Brazil as well. And what you're getting there with one purchase, it's like you're buying a stock. It's like you've bought an entire market. Boom, done. Now, if you have perfect knowledge that a stock outside of Brazil is going to do great, obviously you should buy that stock. Most of us mortal human beings don't have that level of knowledge. And you probably don't want to build your whole portfolio around heroic bets, but rather around a diversified bedrock. So you're basically owning either broad or even actually relatively narrow ETFs that express your view, again, on what's the most important decision, which is what's the broad asset allocation. Something about ETFs, I'd say, is ETFs, they are index instruments, but they are active tools. They are tools for you to build an active portfolio, your own portfolio. And as you build that, you have a huge range of options, which we're bringing to Brazil. You can buy broad U.S. equities, narrow U.S. equities. Maybe you like tech stocks in the U.S. Maybe you like consumer durables. Whatever your thing is, you like banks. We like Brazilian banks, by the way. You can buy U.S. banks. You can buy these, and then those become the part of your portfolio. You've diversified your risk by maybe expressing your investment view, but not concentrated in just one company. So that's the first important part. And the second part is they're low cost. They're significantly lower cost than their active mutual fund equivalents. And I think they're kind of magical. You as an individual investor can get access to the whole world at a relatively low cost, the same price as an institution can. And if you're an institution, you're getting at the same price as the individual investors, all one playing field. And I think that's a magical thing that ETFs bring. They democratize investing, much like I think XP has been doing in Brazil.
Yeah, I completely agree, Mark. But I would also say it creates a new layer of complexity, which is there are so many options now, so many great options that people are always asking us, where do I start, right? And regarding asset allocation, that's a very common question we get all the time, because when we started talking about international diversification, the focus was primarily in the US, right? So people are looking at tech, right? Tech stocks, the US, the S&P 500, but we weren't talking much about different regions, right? Different asset classes. But now there are so many great options in terms of sector investing, in terms of different regions as well that people can invest, that I think it creates a question that people ask us all the time, and I'd like to hear your thoughts regarding different regions as well, and how should they think about investing in Asia, emerging markets, Europe versus the US, right? Because the focus so far has been mostly around the US, and now you have all these different options, right, appearing as well for
So I think it starts, Fernando, with your asset allocation, which is your broad view as to what you want your bedrock, your strategic, your foundational portfolio to look like. And that portfolio should probably access the whole world, not just the United States. And you want to have, I would call it your benchmark position, your basic position, your default position when you don't have a stronger view. That should have a broad international allocation to equities, including emerging markets, but especially developed markets, because Brazil having a heavy commodity role, you probably want to go to economies, if you had to skew towards Europe and North America, that have a lower commodity dependence. That'd be a basic thing. And then the question is, in English we have the phrase "the world is your oyster." Do you have that phrase in Portuguese? The world is your oyster.
Something similar, but yeah,
okay. I'm not sure exactly.
What's not exactly translating.
What's the phrase you would use in Portuguese?
We can say that it's a very small world or something like that, right?
Well, I would say I would say you have all of these choices. These are luxuries for you to choose among. If you have a view on U.S. tech stocks, there are ETFs that allow you to buy U.S. tech. If you want to actually buy U.S. real estate, you can do that. If you want to buy Canada, you love Canada, great country, you can buy that. You want to go long Colombia as a country, we got that. You like U.S. high yield, you like Eurozone high yield. All these are different slices of the global capital markets, and of course, it's a little confusing. But it's kind of fun. It's part of the purpose of it. I mean, the fun of investing is getting out there and seeing the world. And here's what I'd say. It's less confusing and it's much simpler than buying individual stocks. Individual stocks only seem familiar because we've heard of the names. Many Brazilians, for example, will buy Apple. Okay, great company. But you know it because it's familiar. That doesn't really say it's a better investment. It's been a pretty good investment. I think that familiarity is a little bit of something to be careful about. I remember talking to a client in Chile who said, we invest internationally, we go global. And I asked, so where do you go? They said, Peru. And I thought, the world's a little bigger than that. So, but we're all like that. We're all, if you look actually interestingly in terms of home bias, if you look in Southeast Asia, let's say a Singaporean portfolio, they'll have a relatively low allocation to the United States. They'll have a much higher allocation to Taiwan and Korea because those are more familiar. They're closer. My own view is keep that familiarity bias in check. Keep it under control as you're building your portfolio. And then again, look around. What's your view on where markets are going to go? You can express that through ETFs. It's the reason why in the US, if you looked in a traditional retail portfolio in the US, you'd find 15, 20% of the portfolio is in ETFs. But in asset managers, BlackRock competitors, if you look in their portfolios, you'll see lots of ETFs. And the reason is more and more institutions and individuals are saying, hey, I can build a portfolio with these very efficiently and quickly, all on the same level playing field.
I guess you can, as you said, you can express your view in a much easier and cheaper way to do it, right? Relative to spending all the time in researching the best stocks, right, within that sector, right, to express that view, which might take a lot of time, right? So if you like cybersecurity, for example, right, you can buy stocks that are related to that, or if you want to own esports, right? So there are many different ways of expressing a view on a very niche part of the market, right, without having to spend a lot of time doing research on all the stocks, right, within that niche of the market.
You can more efficiently get the broad idea or concept expressed in your portfolio. It's great to buy individual stocks. That's fabulous. We're not against that. We're in a whole business. We have a lot of people at BlackRock doing exactly that, buying individual stocks. The point is, make your default position, your bedrock position, your foundation position, something that has an international exposure. And if you don't have a better idea, a specific better idea, I think building with ETFs is a good assumption, a good default.
Agree. Mark, maybe switching gears here and talking about sustainable investing, right, which is an agenda that BlackRock has been at the forefront. And here at XP as well, we've been very vocal about it. We hosted a big event recently, the Expert ESG, right, bringing the biggest names to talk about this topic, right? It's something we've been educating our investor base here in Brazil as well, because it was not very familiar topic for them, but it has become, right, over the past 6 months. So I have two questions on that theme. And first of all, what's the thesis of BlackRock regarding sustainable investing? And maybe a related question to that as well is, should all investments be sustainable, and should all funds, right, have an ESG criteria, or at this point in time, investors should prioritize ESG related products, if we will, or investments that, right, focus on sustainable investments?
So we start off when we think about ESG or sustainable, same terms, investing as an investments thesis. This is not about doing good for the world. We can talk about that as well. There are clients who want basically to express their personal values, let's say their Catholic values, in their portfolios. And we could talk about that, but that's not what I'm talking about now. What I'm talking about now is how you build a portfolio that has the best risk-adjusted returns you can get. Our view is that taking into account sustainable investments, sustainable risk factors, long-term will give you a better risk-adjusted set of returns. Not a guarantee. We often get asked the question, how will my investments perform? Am I giving something up? I think that's a bit of an outdated question. I think the experience we're seeing is that sustainable strategies will do at least as well as their traditional benchmarks. And the experience has been, actually, they perform pretty well. So they performed exceptionally well last year. They seem to perform less well this year, largely because the price of oil has increased. But what we found in our analysis at BlackRock is when you strip away what's actually happening in the portfolio, what you have, and you strip away often a lot of the sustainability factor, the risk factors associated with sustainable investing, are associated with some other risk factors like quality. When you take that out and you say, what is the actual sustainability contribution? It's quite positive, including this year, even with a rally in hydrocarbons. So the first thing is it's an investment thesis about making more money long-term, one. Two, Brazilians are already hearing this. About 40% of the flows we've had in our own BDRs this year, which have actually been way faster than we expected, have been in sustainable strategies. And that's Brazilians saying, I want to invest sustainably. I want a global allocation, but I want to actually invest sustainably. We're seeing the same thing in Mexico, where we had raised $500 million, maybe it was $900 million, I can't quite remember, in a sustainable Mexican equities ETF. So clients in all over Latin America and all over the world are moving very quickly in this area. Actually, about a quarter of all of our growth last year at BlackRock was sustainably oriented strategies. So clients all over the world are taking advantage of this new, broader lens on risk than we've had historically. So I also think if you look at where the world is headed, this emphasis on disclosing and assessing and analyzing sustainability risks is only going to accelerate. So the G7, that group of government entities, or the heads of state and government from multiple large economies, met over the weekend. And in their communique, the document they came out with at the end, they made basically a statement that we think sustainable investing is going to grow, and we expect issuers, companies, to give a consistent set of disclosures, especially about climate risk. And climate risk is the most important and globally relevant piece in sustainable investing. And they put that in the communique. So this trend from clients is now being amplified by governments. We're seeing that in Europe with regulation that is encouraging the growth of sustainable investing. We'll see the same thing in US out of the SEC in the near future. So all of this is bringing a wave of money towards sustainable investing. Well, how? How do I invest sustainably? The most basic level that really is becoming almost like a ticket to play. You can't even be a global asset manager anymore unless you have what's called ESG integration, which simply means taking into account ESG risks into your portfolio. You will not find any significant asset manager globally who says, I don't do that. Okay, that's done. Everybody says they're doing it, different levels, different quality. But I think that is, we at BlackRock made a commitment by the end of last year, we would be 100% ESG integrated in all our portfolios. We did that. But that's foundational now. This is I'm talking about our active portfolios, not our ETFs. The next level is, do I want to tilt my portfolios? Do I want to put a risk tilt on against ESG risky companies and in favor of companies that I think have lower ESG risk? And I'll give you an example. publicly, there was a very big conflict, a showdown at ExxonMobil a couple of weeks ago. ExxonMobil is a relatively high ESG risk company because they don't really have, at least in the view of many investors, a plan to go forward on how they handle the transition in the global economy to low carbon and ultimately net zero. That's the challenge. And a majority of the shareholders said, yeah, you don't have a plan. And they put directors, BlackRock voted that way as well, put directors on the board of directors to force change at ExxonMobil, because ExxonMobil, in the view of the shareholders, if it doesn't accept the reality and act more proactively to build plans for this net zero world, then ExxonMobil shareholders will do less well. And so the point is that tilt increasingly is becoming, I think, a very reasonable position. It's becoming our default position in how we advise clients. But we, of course, offer many strategies that are not ESG tilted. And then I think actually there's a last piece, which is extremely heavy tilts towards ESG values, which is getting into a zone which is less about investment, long-term returns, and more about expressing myself in my portfolio. And for example, impact strategies, where you have an objective, financial objective, but you also have a social objective. That's also growing. Now, it's a relatively small market compared to what I've been talking about, these broader funds, with broader objectives that are still trying to actually maximize returns, but that's also on the menu. Again, a lot of complexity, but it's how I think global investing is shifting very quickly.
Interesting. Yeah, and in my experience as an equity analyst, right, I've seen companies, right, focusing on ESG for well over a decade, but the focus from investors has changed a lot, right? So now is it the first topic, right, within the corporate's agenda, whereas before companies were talking about it, but it was probably one of the last topics that they would talk about it was their ESG agenda, and that has changed dramatically. And definitely, right, BlackRock is the largest asset manager in the world, helping to foster this change. Right. We're definitely seeing that happening, right?
Fernando, that's a huge. I just want to say that's a great point, and you're emphasizing something that's really structurally changed. So, some corporate issuers have been very ESG oriented for a long time, but their complaint was, the asset managers, where are they? Okay, we do this. They say they do ESG integration, but when I talk to them, they never bring up any human capital questions. They don't talk about our plan on climate, on transition to net zero. They don't ask any of that. So are you going to put your money where your mouth is a phrase we would say in English. So that's changing. It's changing because one, the growth of ESG-oriented strategies, especially in ETFs. This is moving a wave of capital toward more ESG-oriented indices that then, of course, weight companies more heavily that are more focused on ESG risks. Two, the growth of active ESG investing and actually very focused investors who are asking a lot of ESG questions. And the third thing is, and it's starting, although there's a long way to go, is traditional fundamental investors saying, oh, and by the way, I'd like to ask some questions about your ESG risk management. And when that happens, you see this ExxonMobil case, the story there is a big change. That the capital markets will never be the same, because what you saw was an ESG-oriented struggle with management from investors, not from protesters. Okay, it's not a surprise that people who are worried about climate change don't like ExxonMobil. Like, that's not new. What's new is having investors who own ExxonMobil saying the company needs to take more account of climate change. I think that's a really big shift, and I think ESG-oriented investing will never be the same.
That's fascinating. Great points, Mark. Maybe we can touch on risks, right? What do you see as the biggest risks for investors at the moment when you think about the global investing scenario? And we touched a little bit about, right, on climate change and inflation as well. But what are you telling clients, right? What should they be aware when they think about risks?
So it depends, Fernando, on the horizon, of course, who and where they are.
Right.
For Brazilian investors, you have fiscal risks and political risks that are different than perhaps an investor in Norway would have. Different settings. But broadly, globally, I'd say in the short term, I think the biggest risk is a geopolitical shock. They don't come with warning. They don't give you a sense they're coming. The next thing you know, there is a shooting fight between Iran and a neighbor, or you see tankers in the Persian Gulf are on fire, or you see some form of blockade of Taiwan, subtle but real, or you see Russians moving troops into Ukraine. And a shock like that can go through the system. I think the most worrying one is in Northeast Asia, with a risk of either North Korea or Taiwan-China conflict, are areas where those situations can spiral out of control very quickly. And so I think that's a significant risk. I didn't say it's likely. I said that if it happens, it has huge consequences. And I'd say in the near term, that's the biggest risk that we keep an eye on, recognizing that overall, we don't think that's going to happen. We don't know. When you get to the 18 to 36 month horizon, here I think we have more risk of the fiscal and monetary experiments being run in the United States and to a lesser extent in Europe going the wrong way. We just don't know. Could inflation tick towards 4% in the United States? Possibly. Could we see the U.S. debt to GDP ratio getting too high for investors to comfortably finance the U.S. government? Remember, right now, part of the reason why the American government is so enthusiastic about borrowing is that rates are so low. They're negative in real rates. And so what happens if that suddenly becomes positive real rates of 1 or 2%? It breaks the U.S. federal budget. That's a real risk over the multi-year horizon. And again, I don't know what will happen, but that's a real risk that we have to consider. So I'd say those are the shorter term risks. And then the very long-term risk, I think global investors should be worried that the global economy does not get organized around the transition to net zero. Our view is that our clients, you out there, will be poorer in 20 years if we don't get organized around slowing climate change and ultimately getting to net zero. We think that a world, we're talking 30 years from now, where the economies of the world are still putting out as much carbon and greenhouse gases as today, or even less, but still haven't slowed down enough, will be a much hotter world with disasters for many economies around the world, especially economies in the global south. And poorer countries, even middle-income countries like Brazil, face more risk in this way than some wealthier countries. Most devastated risk, of course, is the sub-Indian subcontinent and Africa. Or infrastructure, and they're hot places to begin with. And that is a real, and these countries face true, not just financial risk, but the risk ultimately of, for example, possibly in India, it being too hot to grow crops for much of the year. Hundreds of millions of people not having enough food to eat, water shortages. These are real risks, but that's way down the road, not in the near future.
Right. But we have to act on them now, right? To change them, to change the path, right, on climate change. Regarding the geopolitical risks that you talked about, you didn't mention the relationship between China and the US, and that was very interesting. Do you think that has reduced as a risk with the new administration, or do you think the relationship will remain different than it was, right, going forward?
So when I said the Taiwan-China conflict, that's code for U.S.-China conflict, because where that gets messy is where the United States gets involved. And there are no good answers in the event of a military conflict between the United States and China. That is very bad for the global economy. I think, let's put aside military conflict, put that over here. Bad outcome. That ends in many bad ways. if we're just talking about effectively trade and technology conflict, I think the Biden administration has said pretty clearly, and actually it's really a bipartisan agreement in Washington, that they will continue confrontation with China, but with two big differences. The first is, and actually if you look back at the Trump administration, which had many elements of arbitrariness and obviously polarized the US society dramatically. One thing that everyone actually, I shouldn't say everyone, most people agreed on, including most Democrats, was actually that they celebrated and applauded Trump's resetting relations between the United States and China. And that bipartisan consensus that the US has to reset continues. The two big differences in the Biden administration are competence and allies. So the competence point is that the Trump administration, a little bit shot like this, making, not totally clear what the policy was, to what purpose, made a lot of noise and did some positive, constructive things from a US national security perspective. I'm not making an evaluation from a global perspective. But generally, it was a little random and a little hard to follow and extremely unpredictable. And between two superpowers, unpredictability is not a great thing. The second part beyond competence is allies. The Biden administration and President Biden will work extremely hard to bring a set of allies together to create a united front with China. And the key countries are in Asia, Japan, Australia, and India, and then in Europe, the European Union, and the UK. These are the countries that Biden is attempting to bring into more of a coalition to negotiate with the Chinese on trade and technology. On trade, I think the purpose will be the resetting of the terms of the WTO entry in 2001, which still treats China as a developing country and also exempts them from rules that would otherwise apply to a country that is so state capitalism dominated. And then on the technology side, it'll be about resetting the rules of technology competition, where there's an interesting tension between the US and Europe, where most of the technology companies are US. And so the Europeans, as part of that, will be seeking some concessions from the Americans as well for how the Americans and the Europeans govern those US tech firms in Europe. So I think that's the broad landscape: competence and allies, but consistent pressure, but hopefully much lower levels of surprise, because the surprise is hard for Beijing to deal with. They don't know how to handle those surprises. I don't know how anybody would.
And markets as well, right? Markets don't usually like surprises, right? Brings volatility. Maybe as a last question, Mark, any views on Brazil? You touched a little bit on risks, fiscal, and etc. But any views on
Sure.
Brazil at the moment?
Sure. Well, so first of all, from a commercial perspective, building a business in Brazil, I am more optimistic today than I've ever been. Brazil is the single biggest country that we're not as big as we should be in. And it's because of the internationalization of Brazilian. You, as clients, will be investing abroad with us and with others. And I have to say, I'm just very excited because I think it's great for Brazil. And it's also great for us. I think it's a great collaboration we can do. As an investor, the way we look at Brazil is there are so many things to love in Brazil. We love the technology firms in Brazil, the creativity and innovation, including XP. I think great world-class companies. We also love like the banking system, which we think is very resilient. There are some things we don't love. We don't love commodity-dependent exporters because so much of their capital structure is denominated in dollars. And we are a little worried about the real. And then last, why are we worried about the real? It's about the fiscal situation, the political situation, which we think does have downside risk. I know it's in Brazil, everybody thinks the real is cheap. It's unclear to us. And as a former boss of mine said, the risks are always more symmetric than you think. And that may be the case in Brazil. But long-term, very optimistic about Brazil. Want to build a huge business helping Brazilians get wealthier. and some short-term concerns, but some spots of opportunity, which are world-class.
Fantastic. Mark, thank you so much for participating. I think we couldn't have a better opening to our International Week, having you with us. I think next time you're in Brazil, let's have a coffee, right? A cafezinho, as we say in Portuguese. And,
Fernando, I'm dying to get to Sao Paulo, to Rio. I'm dying. I love going to Brazil, and I am so hopeful that people in Brazil will get to a stable position. Hopefully people in the United States get to a stable position and we can see each other again. I miss you.
Absolutely. We'll be waiting for you, Mark, anytime. So thank you very much. We'll be in touch soon. And guys, the next panel will start at 7:30 Brazil time. Also with BlackRock, we will discuss how do you build a global portfolio, and we'll discuss a lot of the themes here, but more in specifics as well. So thank you very much for joining us, and see you at the next panel. Thanks, Mark.